Hey guys, welcome back. If you've been following along, you're already familiar with the different market structures and the varying degrees of market power that each one offers. And you know that all of the market structures except perfect competition results in market failure. As firms grow bigger and more powerful, their industries become less competitive and tend to move further away from socially optimal levels. But is big always bad? In this lesson, we're focusing on what happens when firms have significant market power, why that power can sometimes be beneficial, why it can also create serious problems, and how governments attempt to deal with abuse of that power. The key idea is that market power itself is not automatically bad, but abuse of market power can lead to outcomes that are harmful to consumers and society. Let's begin by looking at the advantages of large firms with significant market power. One of the most important advantages is economies of scale. Large firms are able to produce at a lower average cost as output increases because fixed costs are spread over a larger number of units. Workers can specialize and firms can invest in more efficient technology. These lower average costs can potentially lead to lower prices for consumers, especially if firms pass on some of their cost savings. In industries like utilities, telecommunications, or transportation, large-scale production can be far more efficient than having many small competing firms. Another major advantage of firms with market power is their ability to fund investment in innovation using abnormal profits. Because these firms can earn profits above the normal level, they have the financial resources to invest heavily in research and development, new technologies, and product improvements. This can lead to dynamic efficiency, where innovation over time improves product quality, reduces costs, and creates new goods and services. Many technological advances, especially in pharmaceuticals, renewable energy, and digital technology, have been driven by firms with enough market power to justify large, risky investments. However, markets dominated by large firms also carry significant risks. Because these firms have significant market power, they often act as price makers. To maximize their own profit, they tend to restrict output and charge higher prices than what you would see in a competitive market. This leads to allocative inefficiency, reduced consumer surplus, and welfare loss. Producer surplus increases, but because the industry is so concentrated, this only benefits a small number of firms, and the result has a negative impact on the distribution of income. Overall, the lack of competition leads to inefficiencies. Dominant firms worry less about cutting costs. This may lead to higher than necessary average cost due to a lack of price competition. Another risk is reduced consumer choice. In highly concentrated markets, consumers may face limited options, fewer product varieties, and less incentive for firms to respond to consumer preferences. In extreme cases, dominant firms may engage in anti-competitive behavior, such as predatory pricing, exclusive contracts, or collusion, which further reduces competition and entrenches their market power. Over time, this can lead to stagnation, where firms become complacent and innovation slows despite their high profits. The firm may be less innovative simply because there's no competition driving it. Even though there are more disadvantages, large, dominant firms award some benefits to society as well. As you can see, big isn't always bad. Market power isn't necessarily the problem. The problem is when firms abuse their market power. But what's the difference between a firm that operates very successfully and a firm that abuses market power? When does that line get crossed? We need a definition. The European Union defines market power abuse in Article 102 of the Treaty on the Functioning of the European Union as occurring when a dominant firm uses its market power to restrict competition, either by foreclosing rivals from the market or by exploiting its customers. In more simple terms, the government wants to ensure fair competition and protect the consumer. Some examples of market abuse could be charging unreasonable prices, predatory pricing below market value in order to drive competitors out of business, giving preferential treatment to some customers, or refusing to deal with other customers. With this definition in mind, we can say monopolies, which have the highest degree of market power, are inherently abusive due to the absence of competition. This is why private, unregulated monopolies are illegal almost everywhere. Oligopolies, on the other hand, are a bit more complicated. Firms in oligopolies may or may not abuse their market power. However, as we learned, collusive oligopolies act like a monopoly, which is why they are illegal in most countries as well. Non-collusive oligopolies don't necessarily abuse their market power, but they could, depending on the situation. Firms in monopolistic competition have significantly less market power and therefore are much less likely to abuse it. Although not impossible, there's usually too much competition from firms producing close substitutes. Okay, so what can the government do to prevent market power abuse? One common form of intervention is legislation and regulation. Competition laws are designed to prevent firms from engaging in anti-competitive behavior, such as price fixing, market sharing, or abuse of a dominant position. Regulators may also impose price caps on natural monopolies, limit mergers that would reduce competition, or require firms to share access to essential infrastructure. The advantage of regulation is that it allows governments to keep the efficiency benefits of large firms while limiting harmful behavior. However, regulation can be difficult to design and enforce. As you can see, the definition of market power abuse is pretty subjective, so different parties may interpret the laws in different ways. This is especially true in global markets. Sure, all countries have competition laws, but they are all slightly different, possibly leaving loopholes that could be exploited. And then, of course, laws are only as effective as the enforcement behind them. Some countries may be stricter than others, but even if a country has strict laws, there is a very real risk of corruption, since these dominant firms have a lot of power and influence on the government regulating them. And of course, as discussed in the lesson on oligopolies, collusion can be difficult to prove. Since collusive oligopolies are usually illegal, these deals are usually done in secret, with little or no evidence to prove firms are working together. Firms found guilty of anti-competitive practices are usually asked to pay fines or could be forced to break up into smaller firms. But these are also imperfect measures. Sure, fines result in additional revenue for the government, but in reality, it hardly ends as a net positive. Remember, we are dealing with very large and powerful companies. They have very deep pockets and teams of lawyers. Court cases could drag on for years and are very expensive. Usually, the fines paid by the company are not enough to cover the costs spent by the government. Also, the effectiveness of fines are very questionable. Many dominant firms actually calculate the risks involved and strategically break the law. If they determine that the revenue gained from illegal business practices will be greater than the fines, they may choose to purposely break the law as a business strategy. Often, these large firms view fines as simply another operating cost. Okay, so if the fines aren't effective at preventing anti-competitive business practices, then the government should just break up the large firm into several smaller ones, right? Not so fast. As we learned in the lesson on monopolies, natural monopolies offer important benefits to society. Due to their economies of scale, their costs are much lower, and they can offer a lower price as a result. So then it wouldn't make sense to break up a natural monopoly, since then the average cost would increase and result in a higher price for the consumer. You also wouldn't want to fine a natural monopoly, since that would punish efficiency. Instead, the government usually takes ownership of the company. When a private company is taken over by the government, this is called nationalization. You usually see this in industries like water, electricity, or railways. The advantage here is that since the government now owns the company, they can force the firm to set prices and output levels that are in the best interest of consumers rather than for profit. This can improve equity and access. However, public ownership can also suffer from inefficiency, lack of incentives to minimize costs, political interference, and slow innovation. Without competitive pressure, publicly owned firms may become less responsive to consumer needs. When evaluating government intervention, it's important to recognize the trade-offs involved. Intervention can protect consumers, promote fairness, and improve allocative efficiency, but it can also reduce incentives for innovation and increase administrative costs. Poorly designed intervention can create government failure, where the costs of intervention outweigh the benefits. The goal is balance. We want the efficiency and innovation that comes with large-scale production, but we need strong rules to ensure that big business doesn't come at the expense of the people it serves. So remember to consider all the factors when you are answering an evaluation question on your test. The IB syllabus contains a massive amount of content on market power and market failure, so you'll for sure see a question about it on your exam. Make sure you're ready. But for now, that's all. Thanks for watching. See you next time.